All right. Welcome, everybody. Happy Monday. Hopefully, it's not a super Monday for you. We're glad everyone's here. You are joining Infinite Giving's Town Hall with some of our investment committee members. So, today we're talking about navigating financial uncertainty as a nonprofit leader. I'm Karen Houghton, a nonprofit investment advisor and CEO of Infinite Giving. At a high level, Infinite Giving is a registered investment advisor. We're a fiduciary and financial partner that works exclusively with hundreds of nonprofits all over the US. So, whether you're tuning in from a small community nonprofit or maybe even a large established foundation, you are exactly who this conversation is designed for. So we know market headlines can be loud, confusing, and rarely deciphered for the nonprofit landscape. And yes, as we all know, it's a little bit different. So today we're going to help cut through a lot of that noise, give you a casual behind the scenes look at our own conversations and at Infinite Giving's insights, again, with some of our investment committee members. So today we want to give you practical, thoughtful advice for nonprofits. And we want you to leave feeling empowered and encouraged by this webinar, just in what our current market is and how we're thinking about the advice and the portfolios that we put a lot of our clients in. So today you're joining a conversation again with some of our investment committee members, including Buster Wright and Justin Pitcock. Unfortunately, Rusty Holcomb is not joining us today. He had a last minute family emergency, so our prayers are with him. So Rusty won't be here today, but I'm looking forward to our conversation with Buster and Justin. Collectively, our investment committee has more than 90 years of investment experience and that experience in managing more than $2 billion in nonprofit funds. So glad y'all are here. Justin and Buster, you guys want to say hey and maybe do a brief intro?
Looking forward to it. I am retired and I come from the national broker dealer network and was the senior managing director and regional officer for that firm for a number of years. And so I spent almost 40 years in the business.
All right. So I've been in the business for 10 years now, 8 of that as an investment advisor, 2 of that as a auditor. And I used to work for Brian Kemp when he was Secretary of State. We audited financial advisors all over the state. And when you're an auditor, nobody likes you. So always wanted to get on the other side of the table and become an investment advisor. So here I am.
I feel like for an auditor, you would have been a really likable one, Justin.
He
Well,
was, we were scared of him, but he's a nice guy.
it was nice
Hey,
when I changed from being an auditor to an advisor, like the pitch there was pretty easy. You hire me or you get another audit, one or the other. So,
amazing. All right. Well, we are glad to have you guys. And again, we're missing Rusty today, but so we did our first town hall format like this last year around the same time. And our goals to, hey, it's been a year. A lot of things are happening. And so we're going to work through some questions, but for everybody tuning in, we're also going to, ask for your Q&A. So if you want to use the Q&A function in your Zoom dashboard down below, you can submit your questions at any time. I'll keep my eye on there and we'll do our best to address as many of these questions in real time as we can. So please don't be shy. Put in any Q&A we have, and we look forward to hearing what's top of mind for you. All right, so let's get into it. I'm going to start with a question that everyone is asking. Is this market volatility different in 2026, or does it just feel different because we are living through it? What do you guys think?
all right. Age before beauty.
Oh, okay. This is market volatility is always a function of what's going on economically in the world.
Yep.
More than that, though, it is the perception of what is going on in the world that runs the market. No matter how electronic or how technologically centered the markets seem to be, it's all driven on human emotions uh, and greed and fear. play a part in there. There are some givens in this current market. The variables that are out there are more than I've ever seen in my entire career. And It used to be pretty simple on a company by company basis or sector by sector basis or asset allocation models and whatnot. But politically, internationally, there's a lot of stuff going on. And the market can take positive news and deal with it quite well. The market can take negative news and deal with that quite well. What drives the markets crazy is uncertainty. And that's unfortunately what we're dealing with a lot these days relative to, let's hit the big ones, the situation in Iran, the situation with oil and the price of oil, uh, the international picture all around. It seems that every country's got its own set of nervousness going on. This morning, the prime minister in Great Britain resigned. And so we're dealing with that. If you don't hear anything else I say relative to volatility and the things that make markets volatile, let me tell you this. In the old days, which I'm capable of seeing, uh, we did not have CNBC. Uh, and I will remind you, and I hope nobody from the network is tuning in, but the way CNBC makes money is selling advertising. And the way they sell advertising is to get the more people to watch their shows. On a minute to minute basis, the market is a pretty dull thing. So they have to do things and say things in a way to get people to be interested and to ramp up people's emotions. They are not helping you, and they are not helping people to make logical decisions. And I just want you to kind of remember that. Don't go to CNBC for your market advice or your market temperature.
When you look at, and Justin, I want you to weigh in too, but when you look at the US stock market fear and greed index, right, we're currently sitting at around 36, which is fear among investors.
Right.
How do you respond to that?
To the fact that the fear index is high.
Mhm.
Well, I mean, it's understandable. I mean,
Yeah.
again, you've got all of these variables out there. AI is something that we all hear about and all talk about. And SpaceX going on its IPO. Most people get excited about what an IPO is anyway, And I had a guy in the grocery store the other day asking me what an IPO was. That's a sign that there's too much information out there. Uh, but yeah, I think I'm really kind of pleased that the market is not any more volatile than it is, to be perfectly honest.
All right, Justin, what do you
We're
think?
we're at, basically all-time highs, so the market goes up 70% of the time. That's kind of the statistic. The odds that the market's going to be up tomorrow is about 70%. The odds that it's going to be up next year is 70%. The longer your time horizon is, the more that odd goes from being basically 70% closer and closer to 100%. If your time horizon's about 20 years or longer and you look back through history, I'm pretty sure you've been positive 100% of the time. So I think it's important to keep in mind of what your time horizon is. And despite what's happening now, I mean, the sky is always falling, if you will. Like there's always fear, and the market likes to climb a wall of worry. So typically, when the sentiment is more optimistic, when it's a risk on market, which I would kind of say that's where we are right now. We've got these big IPOs. People are kind of chasing returns. That's when actually I start feeling a little bit more, all right, let's check in. Where are we? How are things going? Because when that sentiment is too aggressive, that's not a good thing. Now, that said, I do feel like we're going to have a good year. I think there's more room to run. Actually, was looking at some statistics earlier today. So historically, the S&P 500 has averaged between 100 and 150% increase from the previous bear market. So just as terminology here, bear markets is a period of time where the market is going down, typically like 20%. And then measuring from that lowest point to the next highest point, that's normally, a pretty substantial increase over time. So, and that length of time is normally 4 to 5 years. So we're right at a little over 100% increase from the trough of the last bear market. I think we've got room to go. There's a lot of times in history where the market's gone up 400% or more from the bottom of the previous bear market to the next top. So, yes, it can feel like, oh gosh, the market's been doing so good, and it has, but it could keep going. And I think there's a lot of reasons why the market has been doing good lately.
Mhm.
Still, a lot of reasons to feel uneasy.
Yeah.
Again, sky's always falling.
Yes. It is. Someone said when you said the 70%, the market's going up. They said 70% from where? The markets are up 70% from what baseline are you referring to?
So the odds that the market will go up in any given day or even any given year is about a 70% chance when
But
you look at
up
history.
from last year, up from yesterday.
Oh no. Okay, October of 22. And so from October of 22 is was the bottom of the last bear market. And
Mhm.
so we're up a little over 100% from that low in October of 22.
Okay.
And it's very normal for the market to run 150% or more before the next bear
From the
market.
last bear market.
Exactly. That's the point I'm trying to make. Thank you.
Mhm.
Yeah.
All right. So we're in this place where the fear index is high. It's super, volatile is in, we don't know. There's a lot of uncertainty, right? When we're saying volatile, it's like, well, it's really in the markets we're in an uncertain time that does feel more uncertain than perhaps other time periods, right? So when we're looking at that, yet the market performance is still pretty good. How do you reconcile those two things? Buster, how do you think about that?
Well, there's a tremendous amount of money on the sidelines right now,
Yeah.
and interest rates are relatively low. And so the money is going to fall to the place where it can get the most attention. And, there is a lot of very positive stuff, like Justin says. The economics are good right now, and businesses are doing well right now. Um, and so that's the reason that it's going. You can do better uh, relative to risk in stocks than you can other things right now, and that's what the market's telling you. Um, I think the one thing that you need to hear, particularly that Justin said a few minutes ago, especially to those of you who are clients or prospective clients of IG, you've got to think long term. You have to think long term as a board member or an executive director or whatever the position is of a not-for-profit. You're dealing with other people's money. And the kind of things that Justin or I might recommend to you as an individual would be totally different than those things that we would recommend for a not-for-profits uh, funds.
Yeah,
Yeah.
and so the kind of the risk level, I know a lot of folks, have got the money in the short-term treasuries. Okay, short-term horizon. We don't really, I mean, we all love for the stock market to do well, but your treasuries are going to do what the treasuries are doing. They're not so correlated to the stock market. But for that longer term money, the longer your time horizon, the more aggressive you could be. And when, like for an endowment that's trying to, provide maybe a perpetual uh, distribution, I mean, that's like if you're an individual in retirement, it's kind of a similar situation, but maybe the charity, goes on for perpetuity versus a lifetime. But we have to invest. That is a long time horizon.
Hmm.
So kind of my challenge to anybody listening here is when you think about the time horizon, and if it's longer than a few years, it makes sense to be exposed to the market. That's what historically been one of the best inflation hedges long term.
And I think it's a really important call out what you guys are saying on like risk tolerance and time horizons. So a lot of what we do for our clients in giving is right now we're talking about markets in general, right? Which is generally more growth oriented accounts, right? When we're thinking long term and we always say, hey, if we're going into the market, you're accepting some risk, and we're starting to think in 5 and 10 year cycles. A lot of what we do is also short term, more cash management, like get it out of the bank. How do we get you in like a federal money market in T-bills, which T-bills just had another bump up. I think at today's auction, they went for over 3.8, 3.88, I think. And they had dipped for a while, right? So there's all these moving variables. So if we think about nonprofits and how much a lot of it is just fixed income, cash equivalents, treasuries, things like that. How does the market kind of dictate? How do you guys think about for those more conservative holdings? And how are you feeling about market conditions for what those rates will be?
Okay, we need to start from scratch.
Okay.
Uh, whether it's an individual or a not-for-profits funds that are available. There are certain things that we would recommend for individuals as well as not-for-profits, and that is to discern how much money do you need to have for emergencies in your not-for-profit. You know, or have gotten some idea of what the operational costs are of your not-for-profit. Are you giving the money away during the year towards your purpose of your not-for-profit, or the expenses that are coming down the road? You need to prepare for those. And those are the kind of funds that need to be in cash. They need to be in money market funds or government money funds, both of which we have models set up for that. That's
And
money.
cash, just to interrupt, cash is not in the checking account,
No, no.
right?
Higher yielding.
Well,
Yes.
no, that you're losing money. And if I used to, when somebody would say, I'm just going to put all my money in CDs. Well, that's fine. Okay, what are you getting on your CD? Well, it's at this rate, it was 3.5%. Okay, what's inflation?
Mhm.
Okay, so all of a sudden you look at it and net, you're zero.
Yep.
And for an individual, of course, not-for-profits do not have to pay taxes, but for individuals, by the time you pay taxes and let inflation fool with it, then you are losing money. So there is a point where you have to at least try to keep up with inflation. So first thing, figure out how much money you need for emergencies. Beyond that, uh, then you can begin to think about, okay, how can I try to get a little bit better yield? Well, the more yield possible on any investment, the more risk you're going to have to assume. Risk means the value can fluctuate, period. The odds of any of this we're talking about and any of our models of you're losing all your money is almost it is impossible. But there will be the more potential return on the model, the more risk you're going to have to assume. In other words, the more fluctuations. And you don't want to put yourself in a position of having to take money out at a time which could be a bad time. So that's what we're talking about. When you're looking long term, let the put that money away and just, if you can, just sort of turn your head away and let it do its thing and deal with the other stuff on the short term. And so it may be, depending on the size of your not-for-profit, it may be that you have two or three models. We're not saying that you need to put everything in one particular model.
We actually discourage that, right? And to
Exactly.
your point, Buster, it's a for those of you who are watching, maybe be like, Well, how much reserves is enough? How much is too much? There's a lot of right ways to do things, right? If you're looking for a general rule, 6 to 12 months of operating reserves is considered a healthy reserve fund. So once you have those ideas, it's like, okay, we have 6 months of operating, 12 months, anywhere in between there. That becomes your emergency reserve fund. You get it out of the checking, out of a savings, typically out of a bank money market because those rates are even lower as well, right? And then you put it aside and you're like, great, this is our emergency reserve fund. We're not using that as our operating cash flow. This is like over there for emergencies. And if you need it, it's at a low risk, high liquidity rate. But the idea is you're trying to steward it in a way, to Buster, your point, where we can, ideally create a yield higher than inflation. So still very conservative. If you need it, you log in, you transfer it over, it's there. Once you've met that threshold for a cash reserve, then we can start thinking about, well, should we do mid-market or longer term holdings? Should we look at a more growth-oriented account? But that's not what you do with your reserves, right? And so I think that's a really important call out is that when we're looking at this, we do want to look at what's your short term and then cash equivalents. Sometimes we have clients who literally will go from a bank money market to our money market. They're doubling or tripling their yield. They get a fiduciary oversight and they're not doing anything more complicated. And yet they're happy because it's like, oh, it's now we have a fiduciary. We're able to get some policy around it. We have some oversight. It's low risk, high liquidity, and the money market rate is just going to help us a little bit more with capital preservation. Justin, and I know we got a question here about FDIC, but before we go in there, do you want to add anything to that?
I think that covers it well.
Yeah. And
Yep.
it's Buster, thanks for like helping us, pull back a little bit because a lot of what nonprofits do is it is more cash management. And yes, that is we're investment advisors and this is the world. But when you're in nonprofits, like yes, we have endowments and growth accounts, but a lot of what we do and a lot of what we spend time on as an investment committee is like, all right, what are these cash equivalents? What are really conservative holdings? Like we have a government-backed fixed income
So
portfolio, which does move a little bit with the
let's,
market, but we're targeting a conservative outcome.
yeah. So let's talk about that a little bit because I know there was more volatility there than there was in the stock market at times. So I think it helps to like understand the way fixed income works with volatility versus the stock market. So we talked about investing in the stock market in the long term expectations there. It can give you the best return, but it's going to have more volatility. Well, for lower risk, we're going to be using those fixed income, and the lowest risk would be these, money market that's not going to fluctuate. Then you've got your treasuries, and then you could go into a little longer duration. That's a term that means like how long until you get all your money back because of the interest payment. So when you have a longer duration, like it's going to be a longer amount of time before you get all of your money back, that the longer that period of time, the more interest rate sensitive that portfolio is. And so if interest rates increase and you already own a fixed income portfolio, it can cause the value of your current investments, your current fixed income investments to go down temporarily. It's not that they're not going to be worth what they were originally. It's just that somebody else could go out in the marketplace and buy a new, treasury bond or whatever that yields a higher interest rate. So why would they want yours that yields a lower rate? Okay, yours is going to mature and it's going to be worth the face value, the par value. You're going to get all your money back and the interest along the way. But temporarily, the value of that investment that you had before interest rates went up is worth less because if somebody else wanted a new fixed income investment, they would get a newly issued one at a higher interest rate. And to make those equal, it causes, when interest rates go up, it causes fixed income investments value to go down temporarily. Now, this happens with CDs too, but you don't see it. Okay, if you buy a CD, it's going to mature at a certain date and you're going to get all of your interest back. But if you're going to sell it in the meantime and rates went up, if you were to see that kind of that mark to market, you would see that fluctuation too. And if anybody's ever heard of brokered CDs, where CDs trade on the open market, you'll see the fluctuations in a CD It's FDIC insured. So, anyways,
We do a lot of brokered CDs too.
yeah,
All right, so here's a good question. FDIC coverage, right? They say, how do you suggest people keeping funds over the FDIC insured amount if they're holding emergency reserves in a money market? I've got big opinions about this, so I'm gonna take
You
this
go.
one and then I'm gonna pass it to you guys. Um,
I pass that one to Justin.
So FDIC insured funds, right? That is generally best practices for nonprofits, right? This is donor money. We want to be conservative. We want to be cautious. Sometimes having everything FDIC insured is not practical for administrative purposes. So you want to try to find that balance, right? Of just saying, okay, does everything have to be FDIC insured? We can talk about that, right? And people have different risk tolerances and requirements and all of that. The easiest way around cash holdings, right? And this is again, we're looking at very conservative, right? You can look at CDs, right? And then again, you can do CDARS, brokered CDs, things like that, where you can actually increase your FDIC coverage. So that means, like for us, if we're giving somebody, we don't actually recommend CDs most of the time, but occasionally people love CDs. And so we'll say, great, if you want FDIC coverage, we will shop financial institutions. We will choose four, each at 250K. So you feel like you have $1 million in laddered CDs, fully FDIC covered, even though it's at a million. There's also something called an FDIC sweep program. We have an FDIC sweep program that provides coverage on cash up to $5 million and 3.25% on cash.
that's really
Most banks can do a sweep program, but they don't for nonprofits. And so this is one of those things that sweep programs solve the need to have 4, 5, 6+ bank accounts. And it's also important to know that it is FDIC coverage per EIN per bank. So if at one bank you have money in a checking account, a savings account, and a CD, it does not matter if it's over 250K. You're still only covered up to 250K. So that's where diversification or looking at other holdings. And then at some point, though, to y'all's point earlier, is it's like, okay, but at what point will that keep you up with inflation? How are we stewarding those funds in a way that we can actually have capital preservation, still be, equitable and competitive for the future? And so then we start to balance that and say, all right, well, what holdings are cash reserves or your operating cash that you want to steward really well, keep FDIC covered? And then longer term, where do we find kind of that lever? And again, as a fiduciary partner, we kind of work through our nonprofit clients, and everybody's a little bit different. But there are easy ways to do FDIC coverage beyond the bank that I don't think enough people explore.
I think we need to stop right there
Okay.
about something. A lot of people don't understand what FDIC is.
All right. Take us back, Buster.
FDIC is the Federal Deposit Insurance Corporation, which covers banks. All right, and it was created to protect people who might lose money if a bank goes under.
Yep.
If you have FDIC coverage on anything, a CD at your local bank, whatever that is, that covers if that bank goes under. It does not save you from losing money on a CD from that bank. As Justin said, if you cash in a CD early, you're going to be penalized. The only thing FDIC covers is if that particular bank, upon whose good faith and credit the CD is issued or the account is issued, it keeps you from losing by them going under. If you looked at news recently, there were a couple of banks out in Silicon Valley that went under, and guess who came in on a white horse? FDIC. So don't think that the only thing it covers is if that bank goes under. It's not any guarantee of the performance or any of that kind of thing of whatever the instrument is.
Yeah.
This is a great intro to SIPC. Can
Exactly.
you talk to that and what that means, Buster?
Yeah, SIPC, you'll deal with brokerage firms or financial organizations that are covered by SIPC. the Security Investors Protection Corporation.
Mhm.
That only protects you if that brokerage firm or that investment firm goes under. It does not protect you if you buy an investment that goes sideways from them.
Mhm.
Or if you buy a bond from an SIPC firm and something happens to that municipal bond or the people that are covered or against whom that bond is written go under, that's not going to help you. It's only if the brokerage firm goes south or does something that they're not supposed to do. And that is paid for by all of those financial people have to put in money into that big account, just like all
All the
the banks have
brokerage
to do.
firms. Yeah.
Yeah, brokerage firms, thank you, have to do that, just like all the banks have to put money into the FDIC. And
Mhm.
it's great coverage because they were created, both of those were created when there wasn't a very good regulatory environment and the banks went haywire or the brokerage firms got in trouble. So that's what that means. And the numbers are based on SIPC are basically $500,000. Now, a lot of investment firms, larger investment firms, will buy additional insurance to where your account's insured up to $2 million, $3 million, or whatever else, if the firm goes under, not on the investments themselves.
And so let's just say your custodian where your investments are did go under. So highly unlikely, but let's just say that they did. And you have an investment portfolio of individual stocks or ETFs, mutual funds, whatever. You still own those mutual funds. You still own those investments. And that SIPC is really just cash in settlement that is covered. So, and so it's 500,000 limit, but of that is 250,000 that's cash. And so a brokerage firm could go under, and if you're fully invested, you still own those investments that are held there. So you'd get all of your money back.
So if we're gonna take it really simple, it's one of those things that yes, it's best practices. You need that. Infinite Giving provides all of that. It's not the end all be all, right? So it's not when you're looking at balancing what your choices are to go back full circle to that original question of like, all right, how should people keep funds over the FDIC insured amount? I would first say, all right, let's balance the risk with what you actually have and the administrative burden. Is it okay to keep $300,000 in an account even over if it's over 250K? Probably, right? But then from there, that's where diversification and moving outside of the bank is your friend. And I think too many nonprofits are like, this is our bank. And again, we love our bank partners. They're very important, right? But it's finding out that's your operating cash flow, that's where your bill pay and all of that comes out of. But you don't want to, typically, most clients do not want to hold reserves there, right? Because it's then you're increasing your FDIC coverage. You don't have access to a sweep program. If you're doing CDs, you don't have access to CDARS. You can't do treasuries. So there's a whole world of low risk opportunities for your cash reserves, which are often going to be higher yields and often better coverage.
And
Um, Go
Karen,
ahead,
one
Jess.
thing I would add too is a very low risk alternative when you've exceeded your FDIC insurance with bank deposits or CDs is treasuries. I mean, that's the core of what infinite giving, that's a
We do a
huge part
lot of
of it.
treasuries,
Yeah,
yes.
exactly. So, you
Yeah.
know,
Because they have the full faith and backing of the US government, which is not FDIC coverage, but who provides FDIC coverage? The US government, who is the Treasury's FDIC. We're getting a ton of questions.
okay.
So we're triggering with this cash. So I know we have other things about the market. But if we're gonna say here, this is a good one that you guys will like. Bob just submitted this. Some of our board members are pushing hard for investing in 10-year treasuries for our endowment. What are the inherent risks of funding this way? And aren't there other options that would yield similar returns with less risk?
Ooh, can I go first?
Yeah.
Yeah.
So, all right. So a 10-year treasury is going to have a, a lot of volatility. Less than the stock market. I don't know what its standard deviation has been historically right off, but the stock market standard deviation is like 16%. So not to get too technical here, with a 10-year treasury, because the duration, which we talked about earlier, is like how long till you get your money back, it's so far away that as interest rates change, you're going to see the price of your treasuries go up and down a lot. I mean, it could be, you could see a year where when interest rates go down substantially, you could see the value of your 10-year treasury increase in value as much as 20%. That sounds great, but likewise, if interest rates go up, you could see a 10-year treasury values temporarily go down by 20%. Yes, it's still worth what you paid for it. You're going to get your money back at the end of the 10 years, but you're going to experience a fair amount of volatility. And if your time horizon is 10 years, I would challenge you to consider investing in a more diversified portfolio and bring in some equity as well. Because your returns are over that 10-year time period have a very high chance of being much better.
I would also say is that an endowment, the goal of an endowment is long-term sustainability, right? That you're providing a continued disbursement of funds.
Yep.
Most endowments are going to disperse somewhere between a 4 and 5% annually. If you're going to disperse between 4 and 5% on that endowment, which that's an endowment is invested, right? And the endowment is invested, and then you're going to pull a disbursement off. And the intent is that you're not buying down that original capital for an endowment. 10-year treasuries right now are like 4.5%. That's actually higher than they were last week, right? So if you're looking at, I believe, right? So if you're looking at 4.5%, and you're going to pull off a traditional 5% disbursement on your endowment, the next 10 years of what you are committing to means you will buy down your endowment and it's no longer an endowment. So I would say, unless you are not, if it's not an actual endowment and you're literally just trying to manage some cash long term, still probably not the best idea, right? But at the same time, if it is operating as an endowment, which is the words you used, generally you want to target a strategy that is going to return at least like an average annual return of 8 to 9%, which is more market oriented. And the reason we can do that is so that you can pull the 4 to 5%. We do 3-year rolling averages, right? To try to, stabilize the ups and downs of the market, but you're pulling that out. And then anything you have in addition, say you did 8%, you pull 5%, that additional 3% is rolled back into that endowment and it's invested. And that means every year that 5% is actually increasing.
In dollars,
And
yeah.
it's increasing, and then that's keeping up with inflation, ideally, right? That's what you're trying to target. So that same gift, right, that endowment is then having the same impact. And even though there's inflation over the next 10 years, you're keeping up with the impact that that amount can have due to inflation as well.
Yeah,
So I would,
you're
yeah,
getting slapped on both sides when you do
yeah.
that. And if you fully invest, if your board pushes you into investing all of your endowed funds into a 10 years bonds, you're backing yourself into a corner because, as Karen says, if you're going to take out the 5%, you're going to have to sell some bonds along the way, and you may have to sell some bonds at a really bad time and lose money.
Yeah.
And so the net effect over a long period of time would be a very negative one. And she also makes a really good point relative to uh, the amount of inflation that takes hold during that period of time. You've got to plan for that. Now, could it be that a portion of your endowment portfolio is in 10-year bonds? Maybe, sure. I mean, that's fine. They obviously, you know, perform exactly what they're supposed to do. They're going to pay, 4.5% per year. And at the end of the time, they're going to give you your money back. But it's too complicated. And most of the time you need to be careful with how your endowment is worded, whether that is off the income or off the total return of your endowment for that particular year. Because depending on how it's worded, you might be digging down under again and getting down into underneath the fingernails on that one, and it starts sort of eating on itself as
Mhm.
time goes on.
And ultimately, what I'm hearing when someone asks this type of question, or boards are like really digging into an incredibly conservative approach, is that we're making a decision based off fear, right? And it comes from stewardship. We want to steward these funds really well. We're scared. We don't want to take risk. Maybe an endowment is not the right fit, right? And is that actually an endowment? And one of the things that at Infinite Giving we do is we look at that holistic view of like, all right, what are our cash reserves? Before you even have an endowment, we need to make sure you have a healthy reserve fund. Is it 6 months? Is it 12 months? And then those are like, great, that's treasuries, money markets, right? You don't want it in the bank, you want it outside of the bank, right? And then you're looking at these kind of cash equivalents and low risk where you can get some nice short-term rates. Once that threshold has been established, then sometimes we work up the risk tolerance, right? Of like, all right, well, do you have any additional funds that maybe we're thinking about in 3 and 5 year cycles? Okay, well, then maybe that's more fixed income and a little bit of securities. And how do we find that risk tolerance? After you've traveled that, that last step is more traditional endowments, right? And when you're looking at endowments, that should be thinking in 5 and 10 year cycles, right? You're looking long term, so you're not riding the highs and lows of the market. And then you feel often better about making those kind of decisions a little bit more growth oriented, even if it's conservative or a 50-50 or 60-40 allocation, right? We do usually we're a little more aggressive on endowments, but maybe not. But then you can say it, but you know what? We're conservative here. If we need cash, it's this. Then we're mid, and then we have increased our risk tolerance there. If you're not comfortable taking on a bit more risk, I would say it may be that an endowment is not right for you. All right. Anything to add, Justin?
I think that covers it well. I was trying to find some data on kind of the worst drawdowns on a 10-year treasury. If you were holding it and temporarily interest rates spiked like they did in 2022. I've not quickly been able to pull that data, but I'm seeing a negative 42. I haven't verified that, but um, just all that to say, a 10-year treasury bond by itself can be very volatile. However, its standard deviation, I did find a reliable source here, it's about half that of the stock market. So 2022 was an extreme case where they raised interest rates faster than any other time in history. So that made bond performance worse than any other time in history. But it led to a period of time where we had great yields on money market and T-bills and, other short-term fixed income. So,
Yeah. Great question. All right, so here's a good one. We know no one has a crystal ball. We can't predict the future, right? If you get right now, there's three of us here, you'll get three different, slightly different opinions, right? And then when you look at, 10 investment advisors in a room, you'll get 10 slightly different opinions about things. But knowing we don't know the future, tell me what you think the biggest mistake nonprofits make when markets become volatile.
Panicking.
And
It's
panicking meaning what? Like we made a
it's
wrong
it's
decision.
changing from your original investment policy statement. Oh my God, we thought we were going to be in the markets, and now it's doing this, and they totally change. Um, you've got to sit down, look at the comparative risk histories of the investments that you're looking at, get your money in the emergency fund to cover you on day-to-day kind of stuff. Um, and leave it alone unless something really extraordinary happens. Uh, that's the most egregious thing that you could do. The other thing having been on a number of boards of not-for-profits, uh, don't get overwhelmed and sort of focusing on fees. Look at the net return that you would have gotten on that particular investment. Now, the beauty of infinite giving, okay, I'm going to get on my sales soapbox right now about infinite giving. The beauty about infinite giving is that it is put together in such a way that the internal fees and the external fees are about the lowest you're ever going to have in any commercial setting. It's the way it's put together is very simplistic and the cost is ridiculously low. Number two, they have Infinite Giving has a system where you can people who are donating to your for your not-for-profit with appreciated securities, Infinite Giving can sell those more cheaply than anybody else and then put the proceeds into the account. The beauty of infinite giving is the system. It's a beautiful system with a lot of really good reporting for the folks that operate your not-for-profit. They can take in very simply securities. Some not-for-profits, it's very difficult to make your contribution with stocks because they don't have a good, smooth process to do that. So you really need to do that. And also be careful if you're looking at other firms to look after your funds for your not-for-profit. Look at the fees and look at them very carefully, and then look to see if the returns that they are showing, whoever it is, are net of those fees. Because if you don't, and you get in there and they say, okay, well, it did grow 5%. All right, that's what they promised that we'd do or indicated they could do. But their fees are X and now we're only netting 1%. So you got to be really careful about doing that. And so do your homework on those before you make any decisions on that. And I'm very comfortable saying that with infinite giving, knowing that they're extraordinarily low and they're all very transparent as to what their charges are. Um, so
Thanks, Buster.
anyway,
Yeah. Yeah, appreciate that. So at a high level, right? It's hey, what is the worst thing that nonprofits can do with these reserves and in a volatile market, right? And it's clearly we're biased, right? You're at an Infinite Giving Investment Committee like roundtable, but it's looking at who deeply understands nonprofits and your needs. We're exclusively made to serve them. I think a lot of it is when you have an investment, whether it's your investment policy statement or a strategy that you do, make sure you're looking at it strategically, but also holistically. What are we thinking about cash? Is an endowment actually an endowment, right? Is that a growth account? Is it not? How are we thinking about our reserves? Where are they? Our operating cash flow, looking at all of that together. And once you have your strategy, let yourself breathe and just take a step back, right? And trust the process. It's when even when you talk about growth accounts, I had an investment committee the other day for a nonprofit, and they were like, Karen, we appreciate how much, like, because I'll dive into risk. I'm like, here's how to think about it, and here's what could happen. But I was like, when that happens, because eventually it will, just don't look at it. We all look at it when the market's down, right? We all do it, whether I'm looking at my retirement account or we're looking at our holdings and our clients and all of that. The reality is, if you're thinking, particularly for longer held 5 and 10 year cycles, when the market dips, I'm like, just don't look at it, right? We're not
Buy
thinking about
more.
this moment in time. We're thinking long term. So if you say it's a long term, you have to act like it's long term and you have to be willing to approach a strategy in that way. If it's short term, then those are cash equivalents. And then, yeah, we go lower risk because, you're looking at a different set of competitive yields. And yes, our goal is to be affordable for sure.
And
Justin, what would you like to add?
It,
let me jump in with
Oh,
one
go ahead, Buster.
really quick
Yeah.
thing. Another thing that you can get involved with individuals as well as not-for-profits is if you've got 10 people on your board and everybody's got a friend or a brother or a sister or someone who's in the investment business or at a particular bank or whatever else. And the worst confusion you can really get into is to try to satisfy all those people, and you end up with your money in 5 or 6 different places, and nobody's really looking at the whole. Uh, and that can be a real mess. And your operations people of your not for profit are not going to be happy because they're going to have to be dealing with all the different accounts, statements, and all of that kind of stuff. And so I
Mhm.
would really caution that you do that and just
And there's conflicts of interest, right? There's a lot of things. I actually spoke to a prospect this morning and they were like, hey, we had a treasurer who was really involved and they loved laddering CDs and they were doing this with their different bank partners, but then they rolled off the board and now there's a new treasurer and they're like, this person doesn't want to do that. And now we're like, well, who's going to do it? And then I was like, well, great. Well, how are you thinking about reserves? How many months of operating? They're like, we don't even know the answers to those questions. So the idea of finding a partner, whether it's us or somebody else, right? Looking at that consistent third party fiduciary who can look at it holistically and say, great, here's where we are. And then the board's job, right, is to oversee that relationship and make sure that they're keeping tabs there. They're not the ones actually doing it. Because to your point, Buster, that gets really messy really quick.
excuse me, Justin, I stepped on you.
no worries. I think the same mistake for nonprofits is the same for individuals. And it's letting fear and greed drive investment decisions. And it's going back to your investment policy statement and staying the course. We know that the market's going to give you volatility. The more risk you're willing to take, the more volatility that means that you're willing to take. And you should be rewarded for that over time. And so when it doesn't feel this way, but when the market is lower, it's actually less risky.
Mm.
It never feels that way, but it is less risky to invest when the market is down than to invest when the market is up. Feels the opposite, but keep that in mind. It's no different than if you were shopping and you see something on sale and you're like, well, if I don't like this, maybe I could get my money back, right? I don't know if we've got a lot of thrifty people on here, but thinking
Yes,
through,
you're talking to nonprofit leaders. We are all thrifty. Yes.
okay, well, you're thinking, okay, if we buy something, then we don't end up using it, am I going to be able to get my money back? Well, if you bought it on sale, there's a better chance you're going to get your money back
Mhm.
versus
And I
full.
think the catch is that occasionally we have people who are like, well, we're going to wait until we get to the bottom market. And I'm like, nobody knows where the bottom is either.
No,
So it's like you just have to be able to be confident in like, hey, what's up, what's down?
right.
Is it going to go higher? We don't know. You cannot, if someone tells you they can time the market, you need to dismiss them right away because no one
That's
can time the market,
yeah.
right? Like the odds are not in your favor.
The
Um, so
best
yeah,
time to invest is when you have extra cash.
yeah. That's a great way. All right, we just have 5 more minutes. So, any last questions, definitely put them in there. We do have one in there. It says, what if we have multiple bank accounts to help encourage sponsorships? I have so many opinions about this. How should our executive director get rid of that emotion? Um, Such a good question. We see this a lot. I would say at a high level, the guys probably have opinions here too, but I would say you have to value that out, right? At some point, it's the pay to play mentality, right? Like, will they, all right, so if a bank gives you $500,000, then you probably want to keep some accounts there. If you're trying to be like, oh, will they give us $500? Okay, what could you be getting on yield somewhere else, right? Like, is that yield competitive? Do the back of napkin math. And then also look at the administrative burden. How many bank accounts? Now you're reconciling all those statements, you're working through all those relationships. Everyone's going to want more deposits. Are they going to give once? Are they going to give every year? And really take a step back and say, all right, do the math. If they're going to give you $1,000, right? If you were at this, whatever you say you're at, 2%, but you could be somewhere that's 4% and then compound that over 2 to 3 years. Is it worth that sponsorship? We want our banks, they're community partners. We understand they're important. But figuring out how we steward our funds is a more of a responsibility, right? Being that fiduciary over the donor dollars is more important. And so figuring out that fundraising friction and where that goes is often something that when you actually map it out, it's not as good as it seems. What do you guys think?
I totally agree.
Yeah, simple is good. I mean, the juice has got to be worth the squeeze to add complexity.
Yeah, I mean, it's, we all of us who've been on boards of not-for-profits, the local bank, buys a new gym set for the Boys and Girls Club. I mean, there are politics involved,
Yeah.
of course, but it's like Karen said, you got to kind of balance that out because you have a fiduciary responsibility being on that board, doing what's best for the organization, period. And so especially in small towns, that can be a real sticky point.
Yeah. So proceed with caution. I would say for the executive director, you're probably not going to remove that emotion at all, right? They're front lines, they're relationship builders, but I think just getting as data driven and just double checking of like, all right, if we're putting on our fiduciary hat of what actually makes sense on the administrative side, the relational side, if they are people that are like, we will not support you unless you do X, they may not be the kind of partners you want anyway.
That's
Um,
right.
so, all right, one last final question to finish out our conversation. The time always flies. All right, guys, if we look back at 2026, a year from now, what do you think a successful nonprofit leader will have done differently than everybody else with this financial side of things? Just a small question.
Been appropriately diversified.
Okay. And when you say appropriately diversified in like cash equivalents and growth, or what do you mean? Or
Well, whatever
different
your
strategies?
needs or
Mhm.
risk tolerances are, you're never going to have all of your money in the right place at the right time.
Right. Free yourself from that expectation.
That's right. And so diversification is the answer. That should be the biggest work. You ought to have that on your bumper stickers and in your office of your not-for-profit. Diversification is what's going to get you there. It's as to safety, as to return. Um, and and candidly, you can look at anybody who walks in there and say, "Okay, how did you make these decisions, board?" And you can say, "Well, we diversified. We didn't put all our eggs in any one particular basket." And that over history of time and experience has been the best thing to do. So you're covering yourselves by being more diversified.
And I think that's a lot of what we do too, is right. Most of our clients have multiple accounts with us, and they're like, great, here's your operating cash. Maybe it's sitting on our FDIC sweep program where they can just move money back and forth for their checking. Here's our operating reserve, maybe a money market or treasuries. Here's some longer term holdings, that's fixed income. And then here's an endowment, and we're looking at longer term growth. Maybe it's a grant that we're holding on until you buy it down, or a capital campaign that wants to sit somewhere to steward. And we have different allocations for all of those accounts typically, or variations of those, depending on their risk tolerance. So good call out. Justin, what would you say?
Hey, we're all accountable to somebody,
Mhm.
and did we do the best we could with their resources?
Right.
And I think about like the parable of the talents. I think probably most people have heard of that. The servant that just sheltered it and didn't do anything with it was, I mean, got called some, like Jesus, I think used the word wicked and like you wicked servant. That's strong wording. I'm not
And that
saying,
equivalent would be what? Leaving it in a checking account?
well, I mean, yeah, doing something that's just doing nothing with it. Now, obviously, you've got to be wise with it and there's, like we've been talking about this whole hour, some of it needs to be very low risk. But if the time horizon's right, then you should be seeking higher yields, higher returns. And I know it's scary when when you're responsible for other people's money, and it can be stressful. And that's where, having a good partner in this can make a big difference.
Mhm. I know when we talk about it in our, investment committee meetings, we're always like, all right, we have, hundreds of nonprofits we're serving. And even though we manage everyone differently, right? There's no pooled funds, we're handling each individual account. There's often patterns that we look at. We're like, all right, here's questions we're seeing. Here's, performance, opportunities. How can we steward that, as, to your point of the parable of the talents, whether you're like-minded in faith or not, I think there's a takeaway for everybody on that, in which it's like, how are we stewarding what we've been given well, and how are we doing it thoughtfully? So when you're working with investments, this isn't just about like, hey, we're just living an abundant life and we're going to do whatever we want. It's like, no, no, no. It's not about excess. It's about having enough that we can grow and serve and do the work we're called to do, and to do it with intention and strategy and thoughtfulness. And having somebody who can join you in that fiduciary responsibility usually is a bit of a burden lift, right? And then not only is it like, hey, we can work with them, they understand us, they understand, how things work. It's also like, hey, here's what we've seen other nonprofits do. Here's what this organization of a similar size in a similar situation, here's what's worked well for them, or maybe what's not worked well. So yes, great session. Appreciate y'all's time. Hope everyone tuning in learned something, had a good takeaway. If you want to schedule, we do free consultations. I think a lot of folks on here are already clients of ours, so it's good to just meet some of the faces and folks behind the portfolio decisions that we make and the recommendations we make. And it looks like we're putting in chat. Lauren just did that for us. So thank you, Lauren. So yeah, check us out online at infinitegiving.com. Again, we can do consults and kind of talk through your cash management. Of course, if your clients were already, we're always here to help and happy to engage in further conversation. So thank you, Justin. Thank you, Buster. We're sorry to miss Rusty. Prayers to him. And yeah, appreciate y'all's time. I hope everybody has a good rest of the week.